Hello, friends. I'm Ankit Kanodia from SmartSync Investment Advisory Services. We are SEBI registered investment advisory firm based out of Ahmedabad, India. Today, I'm going to present to you my discussion with a very dear friend of mine, Rohith Potti. Now, the interesting fact about Rohith is, even though he has been one of the brightest investors I know and someone with a very clear thinking and philosophy for investing in the market, I think that he has never had any public appearances. So I'm very thankful to him that he agreed to do this for the first time. So we recorded a session a year ago, but due to some reasons, we couldn't put it out on our YouTube channel. But here we are right now, putting it up for you. Immerse into this, take your notes, and I'm going to tell you that you will enjoy this whole video where Rohit deep dives into how he thinks about businesses, how he thinks about investing in general, how he does position sizing, what are risks, how everything. So it is basically a masterclass on an evolution of a bright investor. I hope you will like it. A very good afternoon to everyone. I am Ankit Kanodia, from SmartSync Services, a SEBI registered investment advisory firm. Welcome to yet another episode of Mission Smile guest webinars, a new Mission Smile initiative where we ask our peers in the industry present about their investing journey or one of their investing ideas. Before we begin, I would request everyone to please keep yourself on mute and switch off the video so that we can have a seamless discussion and soak in all the knowledge. You may type in your questions on the chat box. So let's begin. Today, our guest is Rohith Potti. I have known Rohith for over a couple of years now. Rohith began his journey into the world of investing under Professor Sanjay Bakshi at MDI Gurgaon. He spent 3.5 years at JP Morgan as a credit analyst before quitting in 2016 to plunge into investing full-time. He manages his family capital and also does research on Indian businesses. He has worked with Ian Cassel in the past and currently contributes video content on MOI Global. I'm sure many of you are aware of MOI Global. Recently, Professor Sanjay Bakshi was also interviewed by Rohith on that same platform. And before starting, I would just like to share one particular aspect of Rohith, which I believe everyone will agree, or probably his friends would agree, right? So I don't know whether you can see my screen or not. Can you see my screen? Can anybody?
Yeah, it is visible.
So yesterday, from SmartSync Services handle, we tweeted this snippet from the book, The Psychology of Money, which is a very famous book by Morgan Housel. And however, we didn't tweet it purposefully to share it today, but it just came out this way that I found it very relevant today. So investing is also like turning down that treat meal and burning net calories. It's hard and requires self-control. It's easy to find influencers wearing fake masks of investors on social media. It's harder to find real long-term investors, as by definition, their success is more hidden. So with this, I would just like to, I would just request Manan to say a few words, because Manan has been very old friend of Rohith. I think more than 10-12 years now. And I think if we can have something from Manan, and then we can start our discussion today. Over to you, Manan.
So, can you hear me?
Yeah, Manan, please go on.
Great. Thank you, Ankit, and it's my pleasure to sort of talk about Rohit for a few couple of minutes. So, as you mentioned, I know him. He was my batchmate at MDI, and we have known each other for almost 12 years now. Uh, and before he also like properly started investing, so we have been talking about investing since almost 7 years, and that very regularly. Uh, he is one of the guys who have had the courage to plunge in full-time equities, leaving his very cushy job. So I have not seen many people who leave their nice cushy job in companies like JP Morgan and starting full-time investing, and that too from right from scratch. So without any like uh, backup or something. So it's very few people have that sense, that kind of courage to take up anything. So hats off to him, and he has obviously delivered phenomenally well, phenomenal returns he has made over these 7 8 years. So congratulations, Rohit, for that. Secondly, I'll couple of aspects of Rohit I'll talk about is one is his honesty and integrity. So a small like I'm not sure if you are aware, but he worked with a bank. I'll not name the bank after MDI, and he left the job from like one of the reasons was that he did not feel the products that they were selling, he did not feel it was right for the customer. So that kind of he brings that kind of integrity to the table. Needless to say, is very smart and diligently works on his companies, and you will get to learn a lot. And I have learned a lot. One of the things that I'm trying to incorporate but still not able to. He has that ability to change his mind when facts change. I'm not sure who said it. It is attributed to Keynes, but might not be true. But he has that ability. It is very easy. It's very easy to say, but difficult to implement. And I have seen him implement it over and over again. So I have to learn that from him. We have been talking a lot, and uh, our styles have started slightly diverging, but we have a lot of discussions and we have a lot of disagreement, but all those are taken in very good spirit. And both of love like I love talking to Rohit, and I enjoy his conversation. So I am sure you guys will also enjoy this. So all the best, Rohit, for the future, and I look forward to this session.
Thank you so
Thank you.
much, Manan, for agreeing to do this. And
This is a very nice touch, Ankit and Manan. Thank you so much. So, guys, just remember that Manan is a very close friend, and we speak so often that at one point in time, my wife had a doubt about my fidelity. So please take it with with more than a pinch of salt, whatever he's saying.
now, uh, without wasting any more time, we'll straight away come to the questions, which I'm sure most of our participants would be very, very interested about. So the first question, Rohit, to you would be, tell us about your early days as an investor. What made you believe that this is where you belong? Any specific incident or person that influenced you to take this plunge? I'm sure Manan would be one of them.
Yeah, that's true. So first, thank you for doing this. Thank you for including me this, Ankit. I know SmartSync is a very precious thing to you, and you invited me to be a part of this in a small way, and it's an honor. And I'm sorry that it took so many postponements and confusions before we could start this today. So thank you for the patience and for including me. Uh, so now coming to your question, so I am very, I mean, with time, my suspicion about my mind has only increased. And it's been fueled by my observation of my mind as well as what I have read, uh, as well as what I've read of the works of Taleb and other behavioral psychologists. So I think our mind tends to find patterns and stories where there are probably none, and I might be falling into the same trap here. So how I see it today is probably that there were a lot of parallel energies that came together, and this happened. I wouldn't say that. from first off, I believed this is where I belong. But let me tell you a few things probably that came together. So first was that I had a education loan, which was a significant amount for me, around 10 lakhs, and I had to pay it off. And till I paid it off, I mean, I was like a horse with a tunnel vision. I couldn't think of anything else. So I didn't want to leave JP Morgan till that was over. But once I finished my education loan, right around after my marriage, I started getting restless. So that was one energy. And around that time, Manan was a huge influence. We used to talk, and so I used to believe that only superstars like Professor Bakshi could do this full time. I didn't think this could be a full time career. So Manan convinced me that this could be a full time career because he had quit JP Morgan to do equity research with a few firms, and I started playing around with the idea. Now, the problem with uh, being in a work where you're not enjoying it is that any other work seems very nice. So I think of it as grass is greener on the other side syndrome. So I was unsure if I was falling for the same trap. So what I did was I spent time during my work outside of my work after my wife slept and before she woke up, etc. To work on investing, to work on different companies, and I put some of my work out there, which was appreciated. So that appreciation made me believe that okay, I have the aptitude, and the fact that I was doing it outside of my regular commitments like my work and spending time with my wife, who, I mean, we had an arranged marriage, so I owed to her to spend time with each other and understand each other. So the fact that I was doing hard work outside of my regular commitments made me think that okay, this is something maybe I could do. So around this time, again, Manan introduced me to uh, Arpit Ranka, who's been another phenomenally influential person in my life after I got into investing full time. So I think of it this way, that Manan took me to the terrace and showed me the beautiful view, and Arpit pushed me over the edge. Uh, so so he pushed me into doing this full time on an independent basis. That was another parallel force that came into play. And finally, Ankur, who's also a student of Professor Bakshi, he started his internship program at around the same time. And I was lucky to be selected for that internship program. So when I got that internship program, I spoke to my wife, and she was perhaps the strongest parallel energy. She said, "Ki you're spending so much time on this, and if this is what you love to do, why don't you do it full time?" Then there are other competing ideas as well. So I like the idea of compounding, and I saw that. I mean, so compounding formula is I mean, A is equal to P into 1 + R raised to T. I had juniors in my work who were much better than me at my work. So I thought that the rate of compounding and the tenure of compounding would be much higher for them than for me. And I could see myself in my mid 30s bringing some frustrations home from work. So that was also a part of the whole thought process which led me to. So a lot of these parallel forces or energies sort of pushed me over the edge, is what I would say, as far as investing is concerned.
Sure, Rohit. So, just wanted to tell to everyone that Rohit talked about Ankur. He's talking about Ankur Jain. Uh, so many of you would not be knowing about him because he also doesn't have too much of a social media presence. But uh, I have been lucky, and I actually did his internship only because what Vikas and Rohit talked about their experience uh, during their internship. So I would also highly recommend every one of you to at least go through his blog post. I think his blog post name is Calculated Wager or something like that, right? So moving on to the next question, Rohit. What kind of earning notions did you carry with you as an investor, which you no more carry today? I mean, any particular strategy or association bias or maybe authority bias? I'm asking this because I had a narrow vision of investing when I started off. When I look back, I think it was largely because of some authority bias. Did you face something similar?
Well, yeah. So I think very differently about pretty much everything. I think from when I started 5 years back or 6 years back, and I would not be surprised if the same thing occurs in the next 6 years. So please don't hold me to any of my answers today. But having said that, Ankit, yes, authority bias was a huge thing for me as well. I think it is probably because of the way I was brought up. I was an ideal child. I listened to elders, did the right thing, topped this. I mean, got good marks, was a school leader, etc., etc. So, and that's because my mom and my dad thought that was how an ideal child should be. So I don't think it's a bad thing because I'm very happy where I am right now, and of all the alternate universes possible, I think this is a great place to be. I'm very happy with everything that's happening in my life right now so far. But yes, authority bias has been a very influential part of my psyche. Uh, and I graduated around the time Professor Bakshi was shifting from quant investing to quality investing, and I mean, I think it is quite obvious, and everybody knows that he's a exceptional teacher, and uh, he's a powerful force in himself. So just to give you a background, till 2012, when I had my course with Professor Bakshi, I used to think of stock market as gambling. I am from South, and in South, the equity culture is not so great. It was considered to be pure gambling, and only the not so good people or the good for nothings go into this field, to be honest. So it's after his course that I started getting fascinated by investing and how it is not just about investing in the market, but there's a whole other side to it. But that aside, coming back to your question, my initial notion. So influenced by Professor Bakshi, influenced by my readings of Mr. Buffett and Munger, I started primarily trying to do secular investing, but that did not work so well for me. I mean, I'm speaking of the first 2, 3, 4 years. The reasons is, I mean, I think in retrospect, this is what I think the reasons to be. So number one, Buffett, Munger, Professor, etc., had a 2, 3, 4 decade. And in case of Buffett and Munger, even longer before they decided on quality investing, and they've been doing it for a long time. So I didn't feel equipped to figure out what is a good quality business, what is a bad quality business. How do you determine, for example, the quality of, let's say, something? So let's say, is Hester Biosciences a better quality business, or is Bajaj Auto a better quality business? What are the ingredients of a good quality business? So while he is it's like that famous quote, right? While he's given us a lot of theory, I figured ki in practice, theory and practice is quite different. Uh, so that happened, and I also there are a couple of other things which I figured out. So there's this Motilal Oswal study which sort of came out with a report that I think only one or two companies had compounded its profits at more than 15% for 15 odd years. So that was also quite an eye opener to know that in a country like India with such a large population and a growing economy and unorganized everything, there's only one or two companies which could do more than 15%. So I started questioning the odds of secular investing. So the first notion which I would say I have changed is secular versus cyclical, right? So secular investing required a certain degree of experience, certain amount of insight, which I don't think I had at that point in time. I would never say never, but I figured ki it's something which I probably might need to develop to. And if I don't develop to, that's absolutely fine as well. I found the base rates for secular investing to be not great because of the very nature. There are not many great businesses, right? I mean, even Buffett, Munger, they are rarely active. Maybe 2, 3 times, or maybe you can count the number of times in a one hand how active they are in a decade. So that was one angle. And on the other hand, I read this book, Capital Returns, and I found cyclical to be a very interesting way of investing. So cyclicals may all you need to look at is industries which are in a down cycle, find good companies and invest. I'm making it very simple, but the base rates there seem to be better. So there are many industries which are going through some sort of down cycle at any point in time, and the base rates of finding something seemed easier. There is that quote, right? You align with the forces of the universe, and the universe will do its work for you. So cycles, in my opinion, are a very, very fundamental part of the universe. I don't think secular is as fundamental a part of the universe as cycle is. So you have Earth revolving around the sun, moon revolving around the Earth. You have seasons moving in cycles. You have human body having its own cycles. So cycles you can see in physical systems, in human systems, etc., in weather, etc. So cycles seemed, and I see it somehow fit me. It fit my personality to look for cycles. So this secular versus cyclical. So my portfolio is more, I would argue, cyclical than secular, is how I would put it today. So that is broadly one notion that has changed. The second notion is analysis versus money management. So when I began, the focus was entirely on analyzing businesses, understanding businesses, figuring out the competitive dynamics, etc. But with time, what I figured is, or I'm slowly trying to appreciate, is that understanding businesses is probably less than, or understanding businesses and whether you want to invest or not is probably 20-25% of the work. In my opinion, the money management part of it, how much to allocate, I mean, even in allocation, I sometimes pair down, pair up, when to top up, when to top down, how to, should we add more when the stock price is down, or should we add more when the stock price is up? So all that is, it's much more nuanced, and nobody's talked about it so much. And at least in the kind of investing that I do, I find it to be super, super important. And I'm spending more time on that than on business analysis right now. The third thing, which is probably a little abstract, is the idea of conviction and versus doubt. So probably I'll send you one article. It's called "The Gift of Doubt." It's an article written by Malcolm Gladwell on on an economist by the name Alfred Hirschman, or Albert Hirschman. So in investing, you hear a lot of high conviction positions kya hai, where is your conviction the highest? With time, I think I've started appreciating the beauty and the importance of doubt. I don't know if I'll be able to articulate it well here, but I think doubt is the most freeing thing that is out there. So I think doubt is extremely important in investing. So I'll give you one or two personal examples. I was just invested in a couple of businesses, and because the focus was on building conviction so much, that a lot of things, including my psychological biases, played a part in building conviction, which was probably not warranted, given my lack of experience, given how I wanted to build conviction, and I did not let it grow naturally. So because conviction was the focus and I did not pay attention to doubt, when I felt, there was a lot of funny emotions like sense of betrayal, etc., when the position did not play out. And market doesn't care who's invested in it or not, right? The stock doesn't care. So there were unnecessary emotions, etc. It was difficult to let go of the position, because so when facts change, I should change my mind, and I was not able to, because the focus was on conviction. On the other hand, if there is doubt, if there is self doubt, if you remain much more humble, you remain aware of your ignorance, you remain aware of of the fact that you could be wrong, you remain aware of the fact that you spent only 5-6 years investing while you're trying to follow the process of somebody. So Buffett is what, 92, I think, right now. So he spent what, 78 years investing, and my total age is 32, 33 right now, and I've spent 6 years investing. So doubt has to be important in my view, at least for me. So okay, let me put it this way: I'm convinced of the importance of doubt in the investment process. So those are the three things I would say, three major important things I would say, which where I've changed my mind. So I I like to be doubtful more often than not. I like to think more about money management uh, as compared to business analysis, and I'm trying to learn more about secular before I dip my toe in it. Yeah, Ankit.
So, as Rohit, you are talking about doubt. That's a very good point, actually. So, I just wanted to rush to a different question right now.
Sure.
So, what is your view in terms of concentration versus diversification in that sense? Because when you talk about, I know what kind of investor you are. So, but I just want you to share it with all our audience today, because I find it completely opposite to what you are doing actually. So when you are saying that you tend to have more doubt, I personally would feel that you will be far more diversified than you are today.
Okay.
So I think it would be great if you can throw some light there. I'm sure there would be much more nuances which you would like to share with us.
Yeah, so it's difficult because I understand where you're coming from in terms of there being a contradiction. So see again, I don't think of, so I don't like or think of terms. Okay, so I don't like terms like concentration, diversification, etc. Because see, what happens is I think words are really powerful. Okay, so you express your thoughts using words, and sometimes the words you listen design your thoughts. So words which are not, so I try to avoid certain words. So concentration, diversification. When you say I'm a concentrated investor, so I think it should be an organic process. I think your portfolio should be a reflect. So why is it called Buffett Munger style investing? Because they designed a style which is so suited to themselves that the style became known as Buffett and Munger style. So I don't think of myself as a concentrated, diversified investor. So where the or I don't want to be bound by those silos. I mean, I like this idea of Feynman, right? So he talked about how you come out with a theory in physics, or yeah, he's a physicist, right? So he said you first guess at a theory, you compare it with reality, and if the theory matches reality over a large number of observations, then you have a theory, right? And if the reality disproves the theory, it is the reality that is right and not the theory. So my problem with starting, so I don't want to start with the question of whether I'm a concentrated investor or a diversified investor, because that is theory coming first. So how I approach it is I practiced. So I see how it feels. So I have I have a business that I like, and I look at certain things which I want to, which I think are important for me. So in the end, it all boils down to that quote by Marilyn Monroe. I'm going all over the place, but these are the thoughts that are coming. So let me just share them. So Marilyn Monroe said that if you can't handle me at my worst, you don't deserve me at my best. So the way I look at it is I look at businesses and I try to figure out if I can handle the volatility in the business, and that will come only through practice. You work on a lot of businesses in the past, you figure out the patterns that work for you, you figure out the patterns that would have worked for you but you missed because of your inexperience or because you failed to pull the trigger, etc. So what happened with me is that I have actually positions of more than 20-25% also, and I have a position which is 3% also. So on one hand you can call me a diversified, or on one hand you can call me a concentrated. So for lack of a better word, because you asked about portfolio construction, I mean, apologies for the terms, but I try and use memorable terms for me to remember. But so in my portfolio or in my universe of business or stocks that I track, I divide into, let's say, four. So one I would call hardcore, second is softcore, third is substitutes, and fourth is not in the portfolio that I track. So hardcore are large positions which take a good part of the portfolio. They could be about 10-15% also. And once again, these are not designed from the beginning to be large positions, but when opportunities present, they become large positions, right? So if I'm not convinced about the upside enough, these won't become large positions. The next is soft core. Soft core is, again, it's a core part of the portfolio because I'm comfortable, conviction, etc. is there. But for me, it all in the end boils down to risk reward. For one unit of risk, what is the unit, how many units of reward am I getting, and that is entirely subjective, right? So that's soft core because the risk reward is good but not as good as the hardcore wala positions. Then there are substitutes. So this is from the cricket team, so you need to have strong substitutes which are hitting the playing 11 or playing 5 or whatever it is. So I'll have businesses which I think I can hold on to for a long period of time, but maybe right now I'm not comfortable enough and I will have a smaller position there. And then there are those who I track. So I don't think they deserve to be in the portfolio. So I try to have at least 3% in a position. So that's a bare minimum I try and keep in my mind. Keep that hurdle it has to cross, right? Uh, and then the tracking positions which I try and follow over a long period in time. So the doubt angle, how do I synthesize doubt and such a portfolio construction is, I am okay to change my mind. I'm okay to pair my position very quickly, and I think the doubt is necessary. So there is always a tension in my mind. Okay, so when I say tension, it's not a bad tension. I don't wake up from my sleep. So my thumb rule is that uh, the position should allow me to sleep. So I have had situations. Okay, so here is another idea which I find very, very useful, guys. So at least for me, I find it useful. I divide capital into three. So most, I think initially I used to focus mostly on monetary capital, कि कितना पैसा लगाया है. So how much money I have put. But now I find other capital to be more important. So I've divided capital into three types. One is monetary capital, second is time capital, and third is mental capital. So mental में emotional भी आ जाता है. So I have observed that in some positions I have 20% of my capital invested, but the monetary capital is 20%, but the time and the mental capital is actually less than 5-7%. I'm not. I mean, it's on autopilot almost, or I don't need the maintenance and capex is not high on those positions. Contrary, I have had 3-4% positions which have taken 10%. So I don't like those, right? So I think of it in those terms कि हाँ ठीक है monetary capital इतना है. Am I able to sleep? What is bothering me? If something is bothering, so I pay a lot of attention to my feeling and how I feel and my intuition, etc. So and that it's not that at one point in time it's something that builds and simmers over a long point in time. Something will be bothering me about something will keep coming to my mind, which means the mental and the emotional time capital is high. So that idea I use to decide allocation. And when you so the way I invest, if I look for quality businesses in trouble with a trigger. So if it is in trouble, the valuation will be low. So even with doubt, I can take positions because valuation is in my favor and I think the business quality is good. So I hope it's everything put together. I hope it synthesizes the doubt, but having large and small positions in the portfolio.
Yeah, Rohit, very well said. So, so if you can just simplify a little more on this. So say, for example, right now, how many positions you would be having today, and how much of that would be in. I'm not asking for names. I'm just asking the number of positions and how many of those positions would be in your hardcore and softcore, and what would be. And my next question would be related to this only, as to then I'll come back to your investing process and all. But if you can just simplify for all of us, how many businesses would be in your hardcore, softcore, then the substitute, and also in the watch list?
So these things move up and down. Okay, so let's say
Yeah,
2
yeah, that I
years
understand.
back. So just say, let's say and it is very flexible as of now. I've not figured out a framework yet, and maybe I need to. It will happen organically. So how do I put it? So 3 years back, there was one position which was, I think, 22 to 30% of the portfolio, and that was the only thing with such a large position. Okay, so there is one position today which is hardcore that's above 15-20%, which was soft core 3 years back. It graduated to hardcore because I added more as time passed. I figured I'm more comfortable today, right? So. Uh, so in that context, it's sort of an operating leverage idea, right? So I could figure out with 5% time and mental capital, this can be a 20% position. So I like that sort of idea when I manage. So today, for example, probably two positions are more than 30%. So they are hard. Then there are 4-5 positions at soft at 7 to 8% today. I think more than 5-6 positions at 7 to 8% today, and then remaining would be substitutes is how I would put it.
Rohit, my next question would be related to this only. I think if you can take us through your investing process, how you go about researching a business, and try to be as detailed as possible so that we can all learn from it. So how is a general journey for you when you look at a business?
So again, I don't try and follow a process. Again, it's so a lot of this process is influenced by my experience and of course Manan and Arpit. But it depends on again business to business. So some businesses in most of the cases, what I do is I go back. So in BSC, Bombay Stock Exchange website, you will have 20 years annual reports available. So I read through everything. And even though I sort of have access to ACE equity through friends and all that, I hard code numbers on Google spreadsheet manually. So it's important for me to read the management MDA commentary annual report and uh, see how the numbers evolve along with the commentary. And see, for example, it's a very tedious work, but sometimes there are patterns that occur, right? So one of the first companies I worked on was Sarah. And Sarah in 2002-3, when it was some 20, 30, 40 crore sales company, they had consultants coming from Switzerland, Italy, etc. for improving their processes. So that was noteworthy. And then what happened was I could see, and the interesting part is you can see how the stock prices performed since then till today. So I saw that, for example, small companies which brought international people and did not dilute much or did not do share split, etc., they seem to have done well. So the next time I see a small company doing that, I see it as a pattern worth investigating. So 20 years annual report, to the extent is possible, is must for me. Uh, and then depending on companies, in some companies I find it absolutely necessary, but wherever available, I'll read all the con calls, all the interviews, all the YouTube videos, etc., etc. And in some cases, small caps, micro caps, etc., I try and find people on the value chain to understand what their reputation is, right? So it's a small company in Coimbatore which I was working on, and I, through my network, figure out how they are perceived. And when you get hear good reviews, that is good enough. Sometimes I'm absolutely uh, uh, convinced that I have to meet the management in this case, so that I'll make an extra effort there. But generally, I found that I mean, if you read a lot of annual reports, if you read a lot of videos, if you read a lot of, if you see a lot of videos, if you read all the con call transcripts, and you talk to a network, a good amount of work is done. But also, I think so. It's not in. I mean, so the question should not be how do you research on a company, because you think of it as a standalone company, that is not enough. So it has to fit into a experience network or a framework in your head of what all you have read in the past. So these things compound is what I believe. So even when I'm not finding anything attractive, I feel restless unless I'm reading an annual report and trying to understand that business. So I think continuous reading of a lot of annual reports, a lot of books, a lot of videos, uh, a lot of articles is important to build a framework in your mind, so you will figure out intuitively what interests and attracts you. So it's just a lot of hard work, and in specific cases meeting management and talking to people in the ecosystem.
Easily you said just a lot of hard work. I hope it was that easy to actually do that work. So, moving on, Rohit, long-term investing and value investing are two very fuzzy words in my sense, in my understanding. Each and every investor talks about it, but there are different versions of it, right? So, like, I would like to call myself a long-term investor. However, seeing how I have invested until now, I would not be sure whether I should call myself a value investor or not. What are your views on these two heavy and often misinterpreted words, or are they actually important enough to discuss? Is what my question is.
Sure. So see again, this is applies for anything that I say today. Okay, unlike physics or chemistry, you can't have subjective truths. I mean, one ball hits another ball, it will go in one direction. You can't say ki mere angle se separate hai and all that. So it's a simple thing. In what we are doing, it's a very subjective thing. So what I'll be saying today is entirely my view, which might not apply at all. So again, we spoke about concentration and diversification. I would say the same answer here. Ki I don't like these tags or names because of what they impose on the mind. Uh, I am a big fan of nameless, I mean, ideas and emotions. I don't like names and terms in general. So, so if you've observed, again, please forgive me if I'm overstepping my bounds here, but Buffett ne ye bola, when somebody says, it is considered as Satyavachan, it's considered as something you cannot argue against. But so I don't think of it that way. I don't think of long-term investor. I don't think of the other word value investing, etc. So I think of it as, I mean, so for me, this nameless ideas matter a lot. Feelings matter a lot. The ideas, wherever it comes from, it matters a lot. So the feelings matter. So, I mean, again, it's a controversial thing. I'm really sorry if so is Krishna important because he said the Gita, or is the Gita important because it was said by Krishna? So Krishna is important for a lot of things. Lord Krishna is important for a lot of things, but in this specific context, I think the ideas in the Gita matter a lot more than the fact that it was said by Lord Krishna, because the ideas are very powerful. So I don't think it is I mean, Buffett saying something doesn't matter as much as the fact that what the ideas, underlying ideas are. That is what matters. So the way I think about long-term investing and value investing, I don't think of them like that at all. I, I mean, so I don't know. So it's hard to articulate, but I see a lot of mm, energy sources moving around here and there when I see the market, or that's how I would try to picturize it. And I am trying to figure out the energy source that I can align myself with. So if I had to use a term in English, I would call myself an inefficiency or an asymmetry investor. So where there is an inefficiency that I can understand because of my personal uh, experience in life. So the way I have been brought up, the things I have seen, my personal experience allows me to be comfortable with certain things, which I think when I see inefficiencies which fit my and align with my framework, that is what I would do. I will not want to do anything because somebody else said it should. I mean, it said it's that's the way it should be done. So so for my investing philosophy is quality in trouble with a trigger. So it captures to a good extent. Quality is something which either has a good asset, has survived like for a long time. So in my mind, for example, PSUs can be quality if they have access to certain specific strengths. So for example, Nalco has the lowest cost bauxite mines and lowest cost alumina smelter in the world. So that is quality for me, right? Something that has survived for 50 100 years has elements of quality. It is not easy to survive 50 100 years, right? So that is also quality. And so when I see something that has survived and has elements of quality and it is in trouble, then I know the valuation is in my favor, right? And then I want trigger also because I don't want value traps. So trigger is I see something that is happening, maybe a management change, maybe a corporate action in terms of a demerger where the value unlocking can happen, right? So I see broadly in these terms, and I am a fan of. So this is also an idea which Arpit Ranka seeded in my mind, that you so the way so to a great extent I like to be paid to wait. So in value investing, or at least in the traditional sense, or in secular quality investing, what you do is you pay and you wait for your thesis to play out and you get returns later on. But there are situations or ideas where you you are basically paid to wait for something to happen. So this took me some time to digest. I'll probably explain it to you guys with an example. So Sangvi Movers is an investment I had made. So at the time I invested in Sangvi, it had a market cap of 400 crore and I think it had a debt of 500 crore. It was going through the worst of times. But what was interesting was, okay, so just to give you a background, I think I should do that. Sangvi Movers is the largest crane rental company in the country. And it's actually the fifth or sixth largest crane rental company in the world. It has some 40 to 60% market share in India. And what it does is, anywhere where there is huge, heavy things to be lifted in terms of hundreds of tons, like let's say a thermal power plant or a refinery or a windmill, Sangvi's cranes are used. Now think about the nature of the work, that you lift very heavy things from the earth and you are suspending it at a height. So if you make an error, you lose life, you lose money. And you know that capital heavy or capital goods industries are generally not that profitable. They have huge working capital, etc. So any overshoot in terms of time or money is a huge cost for them. And this guy is by far the largest. So he's a vital cog in the value chain, right? And he's existed since 30 odd years, is what I remember. Now, the nature of the business was such that in the worst of times, you had competition going bankrupt, and this guy continued to generate 100 crore cash and he was paying down debt. Now, as a business, this company will generate profits only when the capital cycle is really strong, right? Uh, so what was happening was you had a company with assets worth more than 2000 crore trading at an enterprise value of 900 crore, right? So the way I thought about it, again helped by some of my friends, is that uh, if you buy Sangvi movers I bought Sangvi movers at 400 crore, and what the thesis was that this company had made it very clear, the management made it very clear that we are not going to do any more capex, we're just going to pay down debt. Now, assuming they pay down debt and enterprise value remains same, the market cap should increase because enterprise value is equal to market cap plus debt, simplistically speaking. So, in effect, over the next 2, 3, 4 years, as they continue to pay down debt, the market cap will increase, and ideally, the enterprise value should increase because the balance sheet risk was coming down. But even so, basically, I could see that the company could pay down its debt in 4 to 5 years, which meant that just by waiting till they paid down debt, I was making a doubler, and I am getting a return in terms of debt paid on. And over the next 5 years, if a capital cycle begins in terms of a lot of cement plants, steel plants, etc., getting constructed happen, then I get paid a lot. So I get paid some amount if the capital cycle doesn't play, and if the capital cycle does play out, I get paid a lot. So these are the kind of investments that I enjoy. So there's a trigger in terms of debt pay down, and you can never predict when a capital cycle will begin because it's too complicated. So these are the kind of bets where the uncertainty is really high. Nobody knows how to, because if the management doesn't know what will happen in the next 2, 3 years. So in such a scenario, it's very difficult to predict the cash flows in advance. But the downside is protected because the replacement value is very high. The debt is being paid down, so your market cap will increase to that extent, hopefully, and you can wait for a capital cycle to happen. So rather than investing in a business and waiting for a capital cycle to happen and paying cost in terms of time value of money, this was a better way to play it, and this is how I sort of think of investing in general. I hope that helps, Ankit. I don't know if I went off course a lot.
No, that was very, very relevant, and I'm just writing down all the notes on the chat box for others to
Sure.
also note. So paid to wait versus paying and waiting. That's a very good way of looking at investing. So I'll just shift gears a little. So we'll move away from your direct process and all. I would like to know about your internship with Ian Cassel. So you worked with Ian Cassel as an intern for a couple of years, as you said. And I'm sure it was a great experience. Can you summarize the key learnings for us?
See, Ian is probably the kindest person I know, along with prof and prof students. So I think the biggest lesson for me would be kindness and generosity. So he's been kind and generous with his time, with his energy, with his effort. He wanted me to have an exposure, and he actually sponsored everything for me and asked me to come for a conference in US, meet a lot of good people, etc. So the kindness and generosity that these guys have at the top of their profession, and so I love interacting with people. So it's from that poem. I think it's If, where it says you can talk to the kings and neither lose a common touch. So Ian is somebody like that. He's a fantastic human being, and when you see somebody like that, you want to emulate them. You want to give back the kindness. You want to share like they shared, etc. And so that's been the biggest influence. I really want to help people if and when I can, as long as I'm not harming. But that's been the biggest influence for me from Ian Cassel. And the other thing which I experienced while working with him is the power of working with people you admire or people who are great mentors and guides. So they have a way of inspiring you, they have a way of pulling you up, they have a way of. So I used to play video games, and you see these characters level up, right? So when you work with these guys for an extended period of time, you can't help but level up. So they push you, and it's not negative also. So it's an optimistic, encouraging kind of push that they give for you to think in a certain direction. So having great mentors or friends or guides is really important. That's one more thing. And I mean, excuse me. And one more thing is so couple more things. So he's also a great believer in working with others and delegating. So after saying that, I must tell you guys that I don't work on any idea alone. I take the decision myself, but I always have a network of or somebody who I work on an idea with, because working together is a powerful tool. And I mean, the way when partnerships happen, when synthesis happen because of two three minds coming together, it's just fantastic. And so much so that now what I do is, when I see businesses which are able to work with other businesses well, I give them a plus in terms of their ability to work with each other. There's a lot of subsuming of ego, etc., that is happening, and a lot of subtle qualities are sort of uh, uh, are combined in this particular idea of partnership. If you see somebody working with somebody else or willing to work with somebody else, you know a lot of qualities are automatically in them. And specifically coming to investing, Ian had this fantastic framework in microcaps that he looked at. That he looked at companies which had a combination of scarcity, execution, and tailwinds. Right. So let's go with each of them. So when I talk about scarcity, he looked for some company which is producing something unique. There not many competition out there for what. The one of the fundamental ideas in economics is scarcity, right? So he looks for some company which is producing something scarce. It has high quality product, high quality management, high quality service, some such scarcity. And he looked at scarcity at multiple levels, including the share structure. So if he finds a company with a very consolidated share structure, with the owner owning a large portion of the company and then couple of large investors holding, so he loves that situation, because that scarce share structure can really result in outsized returns, because when the company starts performing, the amount of shares available for purchase is very low. So it will really shoot, the share price will shoot up when a scarce asset is being bid for, which is quite common in economics, as we all know. Now, tailwinds is another angle. So he talks about the unidirectional arrow of progress. So just to give you an example, this is his example, that let's take art. It started with cave paintings, and then it moved to pencil drawings maybe, and then it moved to pencil sketching, then oil painting, then we talked about movie projector, then we talked about TV. So that's broadly how it is progressed. So pictures, still pictures come somewhere in between. So you can think of the fact that the unidirectional arrow of progress will take it next probably to 3D. So 3D is a natural progress to this. So he looks at businesses with tailwinds, and only then will he invest in that. So tailwinds are an important part of his process. And the third thing he talks about is execution. He thinks execution is important, because if the company is not able to execute, or the management is not able to execute, the value will not be captured. So you might have great tailwinds, but if the management is not able to execute to achieve its vision, then your outcome will not be achieved. So in terms of investing, teaching, this I would say would rank among the top in what he's taught me, Ankit.
You, Rohit, I was while you were talking about Ian Cassel and his framework of investing in microcap, I found something important. So he recently had a interview with Vishal Khandelwal of Safal Niveshak, where
Mm-hmm.
he he actually spelled down his 8 filters of selecting a microcap. So top down, I think you touched upon some of them already.
Yeah. Mm-hmm.
Tailwind, scarcity, story, undiscovered, and then
Mm-hmm.
bottom ups also. Recession
Mm-hmm.
proof, balance sheet strength, intelligent fanatic leaders, and valuation.
Perfect. Perfect. Yeah.
Great. So now moving on to the next question, Rohit. So I have read the book, The Intelligent Fanatics of India, that you co-authored with Pooja. I found it really fascinating that someone with so little experience in investing, because I assume at the time when you wrote that book, you probably had 2 or 3 years of experience of investing, right? Not more than that. So I really found it fascinating that someone with so little experience in investing could write in such depth about businesses and leaders. So how did that journey of writing that book evolve you as an investor?
Mm. So the answer might surprise you, or you might not be what you want to hear. But so let me share a history. Okay, so like many kids, probably I was quite an irritating, annoying kid when I was young, and my mom used to go to her sisters and mother's place by train, and so we were in Kerala, and sisters used to stay in Vizag, Pune, etc. It used to be 24, 30, 40-hour journeys. So to have irritating kids in the train is quite painful. So what happened was that she started telling me stories, and she started helping me. So my love for reading started from right a young age, and probably because I don't know why, but probably because of the stories she's told or the books that I read, I used to read a lot of books where there was a hero who fought against all odds and who came victorious, right? So right from Indian mythology to Amar Chitra Katha to the old stories of Indian kings to Harry Potter to famous Five, Secret Seven, other books. So it was all about the good guy coming out triumphant after fighting against odds, right? So let me put it to you this way, that the book, I mean, so you said ki I had 2-3 years of experience while writing the book, but I had probably 20-25 years reading books which are probably the same genre, right? And I used to write. I used to enjoy writing to some extent. I used to write letters to my aunts, uncles, etc. I wrote for my wife when trying to impress her, etc. So the storytelling aspect, or mm, the storytelling aspect has been part of my life for a long time. So 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 intelligent fanatics is nothing but great characters, or great human, or wonderful human beings trying to make a mark in the world. Uh, so while writing the book, the way I would say it has helped me become an investor is to figure out that I have this strong bias, or so when I read such the stories of such businessmen, my mind roots for them to succeed. I mean, I want them to be successful. Um, so that is a bias, just because I want something hard enough. So there is a lot of biases that come in, right? So I want them to be successful because I think they deserve it, and the liking bias comes into play. Then the commitment, consistency, then the idea that this, so the bias that this is how the world should be, key good things, good people should get good things. So that's not how the world works. The world, in my view, the world is agnostic, the way the universe works. So the way it helps me has helped me evolve is, I would say, it has further disciplined me in me the excuse me the habit of writing. I write a lot. I write more than average, in taking down notes of my positions, of my thoughts, of different times in the year, on how I think of the how I think of my mind, and my situation of my mind and the market, etc. And it's made me very careful of companies when I am getting fascinated. So if I really admire them, I take a longer time to invest. That's happened recently, a couple of companies as well. When I mean, their valuation has, so I am extra stringent on valuation when I admire the management, which is very silly, and so probably I've gone to the other extreme and I need to work on. But probably that's also been an influence in my investing. So one more thing, I think I don't think people know it, but I'll just mention it. The book is no longer available to purchase at present, because they've pulled it from publication right now.
Yeah, Rohit, I've already mentioned that on the chat. Somebody was asking.
Okay.
So I mentioned
Okay.
that it's
Okay.
out of print. So I have
Okay.
a hard copy and I've read it. Akhilesh and myself, we have already read it and we have discussed a lot on this. So if anyone wants to have a copy of that, we can, of course,
I
courier.
have a Kindle version if it helps anybody. Yeah.
Also, you can share. Yeah, right. Great.
Sure. Yeah.
Sure. So moving on to the next question, Rohit. Now let us know about some of your big mistakes in the
Okay.
past, from where you
Okay.
learned. And
Mm.
I would request you to use some examples if possible, because we
No, no,
learn a
no
lot.
problem. I agree. It's fair enough. Sure. See, once again, I go back to what I said. I don't see them as mistakes, learnings, etc., because those are terms uh, are which don't indicate the real thing, in my view. So, so, so this is quote that I love, which is that it's at the time of victory that your knife should be sharpened, right? So which sort of means that it's at the time of victory that you make mistakes, and it's at the time of mistake that you're probably most poised to win, maybe, right? So, and again, a lot of mistakes you don't even know. You might have made money and so you don't know, or you might have not realized it also. So it's um, so coming to mistakes. So let me talk about a couple of them, and I like maybe that will help you. So one of the first companies that I invested in was ABC Bearings. So my father works in a small retail spare parts store for automobiles, so I knew bearings sell well, and I heard this term FMIG at around that time, maybe fast moving industrial goods, and this company seemed interesting. The utilization was low, and they were paring down debt, so I invested in it. Now, luckily, what happened was in a few months it got sold to somebody, and I made a 3x in 3-4 months. So this is one of my first investments, right? So now this doesn't sound like a mistake, but this was a huge setback for me, because it made me think that this is very easy. So the next 3-4 years after that, I didn't make any return at all. Okay. Uh, so I had invested in another business, which again around the same time, Tangamail is the other business where I invested, and it made 3-4x in 3-4 or less than 8 months. And I thought this is obvious outcome of the genius that is me, right? So I didn't sell. It came back down. It was there for a long time. All that happened, right? So the mistake here was the market rewarding me and it getting into my head, and it's a pattern which is there in me for a long time. So the self observation is important. I don't know what all I've not observed, but I've observed that success gets to my head, and that is a big problem, right? Now here is other thing which would commonly considered as a mistake. So let's go back to Sangvi movers again. It is I've described the business already, and uh, it was so I had a very small portfolio when I started off, a few lakhs alone, and it was 10-12% of my portfolio at that point in time. Okay. Now I had made a huge analytical mistake, and there was a commitment consistency bias also. So I bought it. So obviously the nature of the Sangvi movers business is it is a crane rental company, right? If it's a crane rental company, it depends on capital capital expenditure happening in the economy. It depends on refineries coming up. It depends on cement coming up. It depends on wind power coming up, right? So if it depends on that, has to be very cyclical. Now, the I would urge you to read the book Capital Return. So in that, the framework is that when the capital expenditure is high, that is when you should exit these businesses. And when the capital expenditure is low, so they have this ratio, capex to depreciation ratio. If the capex to depreciation ratio is at an all-time low level or a really low level, invest in the business. So I invested in Sangvi Movers right when the capex was at the peak in its life, right? At the highest ever capex that it was doing, I invested in the business, and over the next 2 years, I think I lost 60% of my capital. And I'm just starting out, and to lose capital of my family and friends, it was very family and myself, it was very painful. And losing 60% of a very small amount of capital. Now, was this a mistake? Is an interesting question, because I reinvested in Sangvi Movers 1-2 years back in the middle of COVID. So I was aware of the business. I was aware of how the cycle played out, and I was looking at the fact that the capex has been zero the last 2-3 years or something, and they were paying down debt using the cash that they are generating. So was this a mistake, or was this a very important tuition that I pay to the market? I mean, why is it just that MBA that we take as education fees? This was a fantastic education fees that I pay to the market. Was it a mistake, or was it? I mean, was it a great learning opportunity? So this is how a couple of things that come to my mind, Ankit. I hope it helps.
Yeah, that was very
And
useful in
sorry,
the
one
sense
more
that
thing I must tell you is that I think it is not correct. I think you probably learn as much or more from winners than you do from losers. Uh, so some of the best lessons, my current the current investment framework that I like the most. So I think there are multiple. One framework is what I mentioned, which is quality with in distress with a trigger, came from one of the biggest winners that I had. So maybe I'll just explain it. So I should give Manan a lot of credit for this, but there was this. So I had invested in a Tata Steel Ka instrument in the middle of COVID. So that was a fantastic investment because I allocated a large portion of my capital. It was my largest position, and it was 2-3x in a matter of 2-3 months. So So let's
Which
say
company are talking about, Rohit?
so it's a Tata Steel.
Okay.
Oh, so it's not Tata Steel ka equity share, it is the partly paid share of Tata Steel. Okay. Okay. So just to give you, I mean, do you think, shall I explain the situation to you guys? Yeah, so okay, so
Please.
Tata Steel has, so like every other company, it had a common stock or a common share outstanding. And somewhere in 2018 or 19, the company decided to raise a partly paid rights issue. Okay. And the partly paid up rights issue was such that it was a 25% partly paid up rights issue, which, so they had a price of around 500 odd or something like that. And they took only 25% of the capital upfront, and they were planning to call this issue at a higher price down the line. Now, what happened was that right after that, the economic went down and the COVID hit. So you have, and they were supposed to finish calling the instrument in a specific time frame. Okay. So what was happening was that this share should ideally trade at 25% of Tata Steel share price. The time I looked at it, it was trading at 12% of Tata Steel share price. So if Tata Steel was 200 rupees, it was supposed to trade at 50 rupees, but it was trading at 25 rupees. So it was sort of a leveraged option on the Tata Steel shares, right? So this was in the middle of COVID, and Tata Steel is probably the oldest Tata Group company. It I think had a 30-40 long history of dividend payment, and at that price, I think we were getting a 5-6% dividend yield. So I was getting above FD rate dividend yield from a company which is one of the cornerstones of the Tata Group, and it was a leverage call on the Tata Steel shares. Now there are few things that could happen to Tata Steel in the sense that economy could revive. There were talks about Europe operations being sold off, and the interesting part is in one con call towards the end, somebody asked what is going to happen. They said they're going to resolve it in the current financial year, or they're looking to resolve it. You talk to the company secretary. The company secretary was also cognizant of the fact that they're trying to resolve the issue because it was quite irritating for them. So just to give again a context, so the way the partly paid was issued was that they took 25% rupees upfront, 25% of the money upfront, and they're supposed to call 75%. So they issued it at some 500 odd, and they're supposed to call the remaining 75% at a price of 625. And Tata Steel was trading at 300 rupees at that point in time. So the call was very far away. They couldn't call the shares. But the time horizon to call the shares also had elapsed, and they had to resolve it somehow. So again, it was in a way quality. There was a trigger and there was distress, right? So I mean, you can see, so this made phenomenal amount of money. There were mistakes also made. So here is, this is where the framework came out. When there is a major trigger, when there is time stop on a trigger, and in a business which you will survive, and the odds are really good, you bet big, right? And what happened in terms of allocation was I over allocated, and the mistake there was that when stock started going up, I started getting jittery and I sold off quickly. So it went all the way up 7-8x, but I couldn't ride the whole ride up because I had a large allocation and the mental capital was very high. So that was a different learning, but the framework came from this investment thesis and goes back to my original point. So, which is that you learn as much or more from your winners as much as you do from losers. So please don't ignore them either.
Great point, Rohit.
Yeah.
So moving on to the next question, Rohit.
Yeah.
I have a few follow-up with the point which you mentioned, but I'll first finish up the questions and then I'll come to
Sure.
that follow-up question. What is your general filter today in today's time? As in, what kind of business you would like to own and what kind of businesses you would try to avoid, and why?
So more than businesses, I would say it's investment situations, for lack of a better word. So again, that Marilyn Monroe quote, right? So things which I think I can't stick with by volatility, I'll try and avoid. So just to give you an example, I avoid textiles, right? So I avoid textile businesses because I am not comfortable with them for a number of reasons. Number one, they are extremely labor intensive. So if the government increases the minimum wages by a little bit, it's a huge impact on them. If you see the revenue per revenue per employee is among the lowest for textile industry and maybe tea industry also. So I avoid textile industry, one, because of labor intensity. It is extremely capital intensive, right? And it is extremely legal intensive, because when there are so many labor and so many capital involved, there is the laws are also very particular about the textile industry. And then you will have a lot of dependency on raw material, right? So cotton prices are important, yarn prices are important, the export scenarios are important. What is happening with the free trade agreement between Bangladesh and Europe is important. How much SOPs the government is giving is important. So the number of variables are too high, and I don't think I can uh, sustain investing in a textile company through volatility. It has worked phenomenally well for a lot of great investors, but for me, the way I am designed, I can't stick by textiles in volatility, and so that is something that I avoid. So I like simple simple ideas where the number of variables are not that many. So there will be a lot of mess, but the quality of the underlying business would be good, and where there will be a general aversion to the in the general public. So for example, in the middle of COVID, my biggest purchases were probably real estate companies, which everybody thought would not work. Today, probably I'm interested in checking out IT companies, because I think it's 30 odd percent below its highs or something like that. So where there is aversion, and IT is considered to be quality, pharma is considered to be quality, and who would have thought 2 years back that IT companies would be the one which are going through pain right now? So that would be something I'll look for. So some sort of quality with limited number of variables to look for. So I like really major tailwinds coming in industries where there is no disruption risk or anything, and where survival is not a risk.
So you have covered what you would like to do, as in what you would like to own or maybe look into. But what you would completely avoid is also something important. So what
Yeah.
would you avoid today, for example?
So for
Or
example,
what would you have avoided during COVID times? If we compare these two times, today and COVID,
so
which are the
anything
companies
that
you would
I
avoid?
don't understand much, I try and avoid. So even though Buffett has done a lot of insurance and taught us a lot of insurance, I don't understand insurance in India. I don't invest in insurance at all. I don't invest in textiles. I don't mind. So management is okay. So I don't like. I'm not able to. So again, see Vedanta, except or companies where promoters are not that, whose integrity or governance is not that absolutely clean. They've made money, but I don't think I'll be able to stick with them. So any company where the governance is out and out bad, I would avoid them. I would avoid them, because again it comes back to that mental capital, monetary capital framework. They could be having a small portion in my portfolio, but the mental capital allocated would be much higher than my comfort zone.
Right. I have a couple of questions, but I think I'll give the chance to a few participants first,
Sure.
if they have any question. Right. So I think Sagar has raised his hand. So Sagar,
Sure.
I'll just you can go ahead, Sagar.
सर थैंक्स फॉर सेशन सर एक चीज पूछना था कैन यू स्पीक इन हिंदी
या
आप
आराम से
बोलिए।
हिंदी में बोल
Yeah.
सकते हो, कोई प्रॉब्लम नहीं।
हाँ सर आपने बीच में एक बार बोला जब आपका कंपनी का कैपेक्स साइकिल सबसे हाई था तब आपने पैसा लूज किया मतलब जब CWIP या फिर मतलब जो कुछ रहेगा तब कैपेक्स साइकिल जब हाई पे था तब आपने इन्वेस्ट किया जिसके वजह से आपका ड्रॉप डाउन हुआ अभी भी इंडिया में 2022 में हर एक कंपनी का कैपेक्स साइकिल CWIP बहुत हाई पे तो क्या लग रहा है आपको थैंक यू सर
No, so please call me Rohit. Are you okay if I answer you in English?
यस सर नो इशू सर
हाँ ठीक है, तो मेरा हिंदी उतना भी अच्छा नहीं है, तो आई एम मोर कंफर्टेबल इन इंग्लिश. तो अभी क्या है कि so there are two ideas, Sagar. There is prediction and there is preparation, right? So I don't like to predict. I'm very clear कि मुझे predict बिल्कुल नहीं करना है. But I'd like to prepare or position. So position and preparing on one side and prediction on another side. तो मुझे प्रेडिक्ट करके इन्वेस्ट करना अच्छा नहीं लगता, बिकॉज आई हैव सीन कि आई एम कॉन्स्टेंटली रॉन्ग ऑन प्रेडिक्शन. because my biases come in. When I invest in something based on prediction, I want my prediction to be right. And if the prediction is not right, I find myself very uncomfortable and I want to, it becomes difficult to exit. तो मैं prepare and position करता हूँ. तो in case of capital cycle, right? तो जब मैं सांगवी में invest किया, उस टाइम इंडिया में capital cycle बिल्कुल नहीं चल रहा था. CWIP was at an all-time low across the country. But this company I thought could survive, and if the capital cycle happens, it will benefit, right? तो वो difference I don't know if I am able to explain. तो इस capital work अभी का CWIP के बारे में मुझे क्या लग रहा है? I don't have an opinion. I know that ये अगर
सर वॉइस
continue
ब्रेक
होगा.
हो रहा है, 2 मिनट रुक के वापस एक बार रिपीट करना, वॉइस ब्रेक हो रहा है.
Okay, sorry. तो आई वाज जस्ट सेइंग कि मुझे प्रेडिक्ट नहीं करना है. व्हाट डू आई थिंक ऑफ CWIP? सी, दिस इज अ वेरी डिफिकल्ट क्वेश्चन. सो आई होप इट कंटिन्यूज, बट इफ इट डजंट कंटिन्यू आई एम ओके, बिकॉज अभी क्या बोलूं. सो द पोजिशन इज इन so the position has made some profit because of debt reduction, and hence I can stick with it waiting for the capital cycle, right? Abhi kya hai ki we need to buy time. The biggest problem is to buy time. So when we invest in a story where you think the money will be made 5 years out, you are paying to wait for 5 years. I don't want to pay to wait. So isme already I've been paid to wait for 5 years for a capital cycle to come. अगर नहीं आता है तो I am happy to exit and leave. I don't know. It's a very difficult question to answer. So I don't try to predict कि वो continue होगा कि नहीं. I'll listen to the management commentary and I'll keep that in mind. But I will not make my decision based on the management commentary. It will be, the decision to buy won't be made. The decision to hold will be based on the management commentary.
अगर आपका आपको आंसर मिल गया है और आपका कोई फॉलो अप क्वेश्चंस है इससे रिलेटेड? सागर, कैन यू हियर मी? ओके, ठीक है. So let's move to the next question. I think Avadut has raised his hand. Avadut, please go ahead.
Hi, I've been learning many new things, the mental capital, emotional capital, and this is for the first time. And I think Manan has also during his presentation mentioned about mental capital. That was, I was struck by the mention of it for the first time. So two questions. Like cyclicals, whenever you say the word cyclical, people first think about multiple variables. I want to stay away from it. That's the first reaction whenever I speak. So I would like to know, how do you bring it down to these are the 3-4 multiples. There should, whenever you come across one company or a sector which is into which falls into the cyclical region, you study it, and what I would like to know the process. How do you boil down to these are the 3 things I have to look at it? Because whenever I have looked at the cyclical things, first thing I look at it whether it's a global thing or it's a local thing. And then if it's a global thing, these are the things, these are the places I have to look at, these are the major contributing factors. So I would like to know the process, how you boil down to it. And second thing, what we have to look at it when we get into cyclicals is margin of safety. If we go wrong, we should not be hurt most. So how do you take care of these things while looking at the cyclicals?
Sure.
Rohit, sorry, before you answer, let me just tell you, Avadut himself is also a very good investor, and he has been investing in a lot of cyclical business also. So just I thought that I should let you know.
So then maybe then I listen to his answer. I listen to his answers first. Huh?
No, after the session, probably I'll introduce both of you together. So maybe you'll have many things to discuss in common.
Perfect. Thank you so much, Ankit. That's very generous. Yeah. So maybe after this meeting, you'll give me your answers, Avadut. I would love to hear them. But see, Capital Returns. If you've not read, I would urge you to read that book. It's phenomenal. It's created the framework. And in India, I would urge you to listen to Kenneth Andrade. He's I think a phenomenal investor who's figured this out much more than me. So I don't have anything to add to both of them. But I'll talk about how I approach it. So I don't like a lot of variables. So I have mentors and friends who look at steel, etc., which I don't do. It's too difficult for me. Steel is too difficult for me. Okay. Um, but coming to specifically cyclicals, I don't see. Let's take cement or real estate, right, as an example. So real estate, right? It's cyclical, classic cyclical business. So generally the cycles are long. So that's one more angle I look at in cyclical. Ki how long are the cycles generally? So sugar, for example, has from my understanding, 7-8 year of bad cycle and 1 year of good cycle. Real estate has 7-8 year of good cycle, 7-8 year of bad cycle is what I understand. So what happened, and I mean, so what are the variables generally that we look for in investing, right? So you talk about disruption risk. So one could talk about media as being cyclical, but in media there is disruption risk also for print and radio maybe, right? So what are the three risks? So there is competition, or three big risks that I look at is regulation, competition, and uh, disruption, right? So these are three big risks, and others are probably specific risks and all that. So if I look at these risks in real estate, Abhi, there is no macro factor involvement, right? China can't come in here, Europe can't come in here. Forget China, Europe. Matlab an Oberoi is not. It doesn't go beyond Bombay to Pune. So it is as local as it can get. And uh, you had a situation where the real estate prices were staying stagnant while the salaries were increasing for IT and consulting and banking people. So I am an MBA, so I see a lot. I have some information on what happens in placement in my college because of newsletters, etc. And every year people are getting good money. So the number of people coming into cities is increasing. We'll see what happens because of COVID, but I still think it's okay. But if you think about it, urbanization is a long-term phenomenon in the world across centuries, right? From times immemorial, people have been moving to cities to work. Even Mahabharata में भी वो stories है, right? So it's a very local business, not even national. It's a local, state, city-wise business also. And if you had enough reports out there from Cassel, your Liesis Forest, then JLL, सबका report था कि the number of builders in each of these geographies is coming down by 60-70%. Now let's go to so disruption risk. मतलब probably the oldest business, one of the oldest business out there, which is staying in a shelter, which is what human beings have been doing. So वो risk भी नहीं है, competition risk भी नहीं है, and regulatory risk. So with RERA coming in, what has happened is it's not regulatory risk, it's regulatory tailwind. So any business with the regulator as a tailwind is very interesting, no? So you had capital cycle angle में competition coming down tremendously. And there was this number which is beautiful. I think the major cities in India, some 7 to 10 cities in India, together sold some 2 lakh homes in 2019 or something. Imagine, I mean, we are a population of 120 crore, that is 12,000 lakhs, and we're selling 2 lakhs home a year, right? So it was just silly in my head, the prices at which some of the real estate businesses were trading at. So that the number of variables is less, right? Cement is another example. You know how much it takes to construct a cement plant. You know that cement is also a very regional business. There cannot be anybody from north coming to south. You know what it is used for. I don't have any much investment in cement at all, but I'm just saying this is another example where the variables are very minimal. So in cyclicals also there are a lot of companies with more variables, but generally variables are minimal. And in so there's a lot of things come together. It's not just cyclicals the way I look at it. I look at cyclical with trigger, and I also look at number of variables, asymmetry also. So there is this is business which I was interested in, not so much anymore right now. This is a small forging company called Magna Electrocast. Okay, so it was it had, when I looked at it, it had a it is a forging, it is a casting company. For the last 10 years, sales has not gone anywhere, stock price has not gone anywhere, but in the middle of COVID, they did a buyback, promoters didn't participate. So that was interesting. And casting company hai. Now what the interesting thing was कि Europe में energy prices going up, casting में energy बहुत use होता है. So I found it interesting, the pattern. Then what I did was I looked at it, and the interesting thing was कुछ हुआ नहीं last 10 years because the cycle was bad. And it was at 50-55% utilization. So if it doubles sales because of operating leverage and the fact that they're going to higher value-add items, it's not pure cyclical is what I'm trying to tell you. So for doubling sales, what did they need to do? They just needed to sell the rest of the capacity. They didn't have to do any complicated land find करो, factory setup करो, वो सब कुछ नहीं करने का था. They'll fill up the capacity. They'll have higher value-added items also, and they were doing some backward integration also, and they were setting up a power plant to reduce their cost. So your profits will, for doubling of sales, if that happens, the profits would increase 4, 5, 7x.
Correct.
So the amount of effort required is only filling up sales, right? So those are so it's not pure cyclical. I want as many things in my favor as possible. I hope that answers.
Yeah, and what I learned is, one thing is you want the good times to last for longer, bad times to last.
Yeah. So that's one more reason why I don't like textiles, because of suddenly change hota hai, is what I found. Cotton, suddenly something happens to the crop or something like that.
Correct. In cyclicals, you have margin of safety in that sense that worst times should last for a minimal time and good times to last for longer. That takes care of your valuation part of also, I think.
Yeah, and again, the valuation starting point has to be very, very favorable. It has to be below replacement cost for me.
Correct.
Because I need to be able to stick through the volatility.
Correct. Understood.
The way you are answering this question, I was just thinking about how Avdut says and how you are saying. So there are a lot of similarities in how you approach investing. So I'm sure both of you would love to interact with each other.
Thanks,
And
Ankit.
another common point apart from Ankit bhai is Vikas. Vikas has told me that how long it takes to new capacity to come in. That is also one important point that we have to keep in mind. That I learned from Vikas.
Oh yeah, so read Capital Returns, you'll love it, Avdut. I mean, that point, I mean, they have created a phenomenal framework for capital cycle investing.
I had listened to his lectures, but I haven't read the book.
Okay.
So I think I forgot my second question also.
I also forgot it, Avdut, sorry.
I will come back into the no problem. Thank you.
Sure,
yeah.
Sure, Avdut, you can come back, no problem. Yeah. I think Akshay had a question. He had his hand raised. Akshay, you can unmute yourself and ask.
Yeah, thanks, Ankit. And Rohit, it's really nice hearing you. Actually, I joined late. I'm in Sydney right now, so kids, I had to put them to bed and all that. But I listened to a few things just now, and you said that you basically prepare, but you don't predict. And I'm sorry, it was not very clear to me. I mean, I got the gist of it, but then when we spoke about other things like cyclicals or anything like, for example, that casting company example that you gave, there's still some prediction, right? I mean, sorry to confuse in between, but I'm just trying to understand exactly what you mean by preparedness versus prediction.
So this idea came from Taleb, who's been very influential in how I think. So he talks about anti-fragility, and in anti-fragility, what he says is that we should not focus on prediction, but we should focus on preparation. So we can't predict. So the context in which he talked about it was probably that so you can't predict what bad things will happen to you in life, right? You might lose a job, you might have an accident, etc., etc. So when I say you might have an accident, you might have an accident and which will incapacitate you for a long time, and you can't do any work, right? So you can't predict these sort of things, but you can prepare for them by having a strong personal balance sheet, which allows you to survive. So survival is the focus, right? So he says that a lot of things in life cannot be predicted, but you can instead prepare for a lot of them. Now I apply that idea in investing in a different way. Yes, right. So survival is so let's take the example of Sangvi Movers. I'm not sure if you were there for that business. So it is a crane rental company which helps large refineries, cement plants, steel plants, wind power plants, thermal power plants, it helps in setting those up. So it's only when those plants are set up that this guy makes money, right? So it is impossible to predict that. So I have followed this business for 6-7 years, and the management is more often been wrong than right about the demand scenario down the line. And there have been multiple false starts on when the capital cycle will start, right? Now the question is, so here is a situation where there's a company available at 400 crore market cap and let's say 600 crore debt, and it is exposed to the capital cycle, and so you can't expect much in terms of profits. So in fact, its depreciation policy was aggressive and it used to generate losses actually, right? So you had a company which was generating huge losses but huge cash flows also. So this dichotomy of negative losses but positive cash flows is because of aggressive depreciation policy. Now, when I invested in Sangvi at that point in time, I knew that the company will pay down debt, right? So it is when you pay, so that is anti-fragility, right? So in the times of stress, it is becoming stronger by strengthening the balance sheet and automatically thus preparing itself for the next capital cycle. It is not predicting it. So when the next capital cycle comes, it has the strong balance sheet to participate in it. So it was in a situation where the competition was dying away, etc. So when I say preparing versus prediction, so when I invested in Sangvi, I was not predicting when the capital cycle will happen. I was agnostic to it to some extent, right? Uh, because if the so at some price it was so cheap, it was trading at I think 30-35% of the replacement value of the business in my estimate, right? And it was paying down debt, so I was paid. Matlab, the enterprise value remained same, and the stock price increased because the debt was being paid down. So I was not predicting the capital cycle, but I thought that when the debt is being paid down, the stock price can go up and the balance sheet. So this will allow me the luxury of waiting, because there is no pain of waiting. I've been paid 2-3 times the FD rates, right? So I'm preparing for the capital cycle to come without predicting for it. So I don't like playing capital cycle by predicting for the capital cycle, if that makes sense.
Yeah,
So
that
this
was
is
perfect. Yeah.
yeah.
No, I got the idea now. Yeah. So basically, the variable that you know is going to be taken care of, and then you pay very less amount of money for that. That gives you staying power in there.
Yes.
And yeah, and that's the whole idea. Thanks a lot for
Yeah.
that. Yeah.
Yeah. Sure, Akshay, sure.
So moving on, I'll just ask Dr. Suvit to unmute himself and ask his question.
This has been one of the most amazing, time periods that I have been through. Brilliant thought process. Just a simple question: how much the effect of networking on your thought process, and does too much networking affect individuals' thinking? So, how do you guard your individual thinking because you must be having a lot of good mentors and a good bunch of people that you interact with, as you say. Then when you have an individual thought process which is different than that, how do you protect your individual thought process when you have a lot of networking effect around you?
Before Rohit answer this, I'll give you one example. Whenever I share any idea, he just dismisses it.
Wow.
No. Oh, no, so I enjoy speaking to Ankit because his style is very different, and I think it's important to have conflicting ideas hitting each other, and something new will come out, beautiful will come out. So this is a question which I did not think of, Dr. Suvit, so it's very difficult. So the way I would answer it is, so one of the best books, or I like reading a lot, and one of the best books, so a subject which I like to read is generally about philosophy, self-awareness, etc. So I don't do it as often as I would like to, but I love my alone time. I love my introspection, and when you have more time by yourself, etc., you'll figure out very interestingly that so just like some companies will chew and spit out people who don't fit that culture, right? Your mind also spits out or chews and spits out ideas which it doesn't want to accept, or it might not be your mind also. It's something probably deeper than your mind as well. So I do talk to people more than I used to before, and you're right that it does impact me. It sometimes gets too much because I want my alone time and I like my space a lot. And the way I think it works for me is that I take my time out to be myself and I just let my thoughts wander. And some thoughts which don't make sense, it just goes off. I mean, it's ejected from my system to some extent. Some thoughts which I think are powerful and I need to think of it is there in my mind to some extent, and I'll note it down or something like that. So I'm saying to some extent introspection helps, to some extent writing down helps. So when you write it down, it's like you take. I mean, it's a interesting thing. Sometimes for what happens with me that something goes from my mind and onto the paper, and that mind space gets cleared. So that also happens to me. So some ideas are very powerful, and I want it to be there, and I think on it more than I would think of other things in general.
Perfect. Amazing, but thank you very much, sir. Thank you.
Yeah, so I would recommend reading more philosophy and self-awareness books. I think they help a lot.
Your thoughts is very good. Matlab, you listen to people, you just off the cuff you can speak things, and that maybe it's the reading and the writing that helps into that process.
Thank you. That's a very nice compliment. Thank you so much. That's a very generous of you to say that.
Thank you very much.
Thank you, Doc. That was really good. I'll next ask Mr. Kailash to ask the question. You can.
Thank you, Ankit, actually, for giving us this opportunity to talk to Rohith. Actually, I know him, from the days of the, intelligent fanatics, books and everywhere. So, sir, now, actually, sir, I have two questions, actually. First question is, sir, looking at the, the life cycle of a company, the age of a company is, declining sharply, actually. The average age of a company in US used to be, 30 plus years. Right now, actually, it has come down to 13 to 14 years. So, shall I assume that actually right now, actually, the Christopher Mayer's book of 100 beggars, we need to got to tone it down to maybe 10 beggars, 20 beggars, because the way, the things are happening in the dynamism of the world and looking at, all the noises of the world. So, sir, my question is this time now to shift the investing from, those who are, little boys to becoming, getting into the teens and becoming men's, or this is the time to invest actually into those who are already in teens, market cap of $1 to $2 billion, rather than investing in, somebody, $200 to $300 million market cap. So is this a time to invest actually into this, those who are in teens and men's, those who are going to become supermans or macho mans? So this is the question number one, looking at the way the dynamic of the world is. And the second, I would like you to add to my thinking actually. So, sir, actually, the way, the world actually, because actually, and sir, on a textile point, actually, I would like to add, the kind of pessimism that actually, I'm into textiles. So that's why I want to get in. I used to tell my brother, actually, ours is the most unorganized business. We don't have any organized, players. In 2012, a guy from the Google with 36 lakh package came to me and he said, I want to, actually make kurtis for, girls. So I was shocked. Actually, at that time, actually, kurtis were nowhere in our picture. Actually, it was all ready-made markets. So, sir, the point is, looking at the female participation into the workforce, that is 20%. That is going to be maybe 40%. And I see my friend's daughter earning, package of 30 to 60 lakhs. It's a common word now. Earning 30 lakhs to 60 lakhs, it's become a common figure for the girls to earn. So the way actually the way they will spend onto the textiles, and looking at the way organized players are getting into our organized player, that I can feel easily. Right now there are so many organized players. So just a thought on the textiles, because the things may get changed. And so the second question is, sir, I think the stocks turnover, the life cycle and the way the turnover of the mutual funds and everything. So is this possible, sir? Actually, the way the gold has behaved, actually, recently, in these times, gold has, the way it has behaved, it has, baffled each and everyone. So is that the stocks are going to be the last resort kind of a, avenue, for the investments? And because I'm a holding angel, I'm giving you an example, holding angel from 300, now it is 1800. But, to hold from here on, and the way I'm thinking that stocks are going to be the only, maybe Bitcoin is in his own world. So your thoughts on that, just thoughts on that.
Rohith, again, before you answer the question, I know Mr. Kailash personally also. So if you add your experience and my experience in the market, and even then that is less than his experience. And he might be addressing you as sir, but actually we should call him sir rather. Yeah,
No,
now you can answer.
it's learning. Yeah. Yes.
Actually, I request to everybody, please call me Rohit and don't call me sir, actually. Uh, so, Kailash ji, you asked me a few questions. So, see, actually, Kailash ji, the way I think about this is that so market is a vast, vast ocean, okay? And in that ocean, I am in some small corner where I'm trying to learn to swim a little bit and enjoying the scenery there. And there are multiple corners of oceans where people can swim and be happy. Uh, so the reason I say this, the way I approach my thinking approaches, I don't think of it in terms of market cap, right? So, abhi, for example, in my portfolio, there are companies from less than $20 million market cap to I think around $3-4 billion market cap. So, my long-term goal is to compound capital uh, at 15, like 2-3 times FD rate over a long period of time. That's how I think about it in general. And coming to your point of life cycle of company, so this is why I don't like the idea of long term and life cycle. वो सब मैं ऐसा I don't think of it that way because very honestly I participate in companies. I don't stick on. I've not sticked on to many companies for more than 5-6 years. Maybe one or two only so far, right? So. Uh, so it's something which I need to work towards and probably develop and probably work on as well. And what you said about life cycle of companies coming down, right? So I think there is two interesting opposite things coming together. So one, life cycle is coming down, but in that life cycle, the money that is made is also phenomenal, right? Because if you think about it, let's take example in India. Sera is a fantastic company in my view, like phenomenal promoters, phenomenal industry, uh, uh, and great tailwinds runway, etc. Compare the market cap of Sera, which was started, I think, in 1978 or 80 or something, I think, and compare it to something like an IEX, right? IEX was started in 2010, probably that was started, but operations began maybe 2-3 years later. Look at the market cap difference, right? So it's really interesting the new age businesses, what has happened to them in terms of scale. Let's think of another example, which is NSE. My goodness, it's a company which is almost $1 billion profit with India's equity penetration rate so low. So imagine what it could be down the line if the regulations don't change much, right? So NSE was started in 1990s, right? So it is again no promoter in India where supposedly it's interesting that you need a strong promoter backing with good political context to make money, etc. Has some. I mean, this is one of the two companies, and look at the amount of wealth it's created. So I think I agree with you that life cycle is probably coming down, but within that life cycle, I think the value creation is also accelerated. Now, if you is there a framework to figure out that acceleration? I am working on it. I don't think I have it yet. Let's see what happens is what I would say there. And coming to what you mentioned about textiles, Kailash ji, about kurti, see, I agree. I mean, you would know more about textiles than me, but one thought that comes to mind is what Buffett talked about airlines and automobiles, right? In 1920s, I think there were some 2,000, 3,000 automobile companies and only one or two survived. And I find it so, forget kurtis, I find it super fascinating about food in India. Think about it. I mean, we are 1 billion population. We love food. The amount of eating out we do is increased. Why is there no pan-Indian chain of a food company? All the chains that we see here, Burger King and all that, which is international, Burger King, Pizza Hut, Domino's, everybody's international formats come to India. Why have we not been able to figure out an Indian chain? Obviously, these barbecue guys are trying it out, but it's not that success. I mean, it's not reached there yet, in my view. They might be doing well, but it's not reached there yet. Think of jewelry again. Why is Titan the only chain here? We are the largest consumers of gold in the world, and we've had a long history of consuming gold. Why is there no chain of gold? So, kurtis as a thing might do very well. Sardis as a thing might do very well, but why are there no chains? Is something which I keep thinking about. What is the nature of the business that doesn't allow a pan-Indian chain, successful chain, to be created for a long period of time? So the scale and sustainability is what I would focus on. And I'm sorry, I forgot your last question.
No, the way the assets are behaving.
Oh, assets are behaving.
The way the gold has behaved, the way the Bitcoin has behaved, so and the way the financialization of the actual markets are happening. So it's a kind of a given that actually the turnovers could be huge compared to the previous decades or two. It could be huge change.
Yeah, so the turnover could be huge. So you try and benefit from that by probably participating in companies benefiting from the turnover. But I don't have, so I don't understand gold or Bitcoin much, so I won't be able to comment on them much, very honestly.
Fair enough. Yeah.
But in case of businesses in general, it makes sense that it's something that generates cash flow. So it's something that I can understand more. So what I understand, I invest in generally. So that last question is out of my circle of competence. वो
Fair enough.
syllabus से बाहर हो गया मेरा. Sorry.
No, thank you. But life offers, out of syllabus only. Yeah. Okay, thank you.
Yeah, thank you, Kailash ji.
Yeah, thank you.
Oh, I can't hear you, Ankit. I don't know if it's my problem.
Okay, I was muted. Sorry.
Yeah, okay, yeah.
Yeah. So I see Dr. MP Bajaj just dropped, or I can't see him.
No, I'm there.
Okay, great. Yeah, please go ahead.
Yes, Ankit, thank you for bringing Rohit first. Second, Rohit, it was an excellent extempore education, and I find it very difficult to mine your knowledge in such a short span of time. Problem, what happened today, I was not able to write the points, what you mentioned. So actually, I have to see at least two to three times your video. Have you got any presentation where you have mentioned these points?
So thank you so much for your compliment, Mr. Bajaj. It's really nice of you. I don't speak. I mean, Ankit is a very good friend, and he insisted for more than a year. That is why I came on the platform. Otherwise, I don't like to speak much in general. I like asking questions like Ankit this. I just don't like being on the other side, actually, to be honest.
And second question, what I fathom out is that mostly you're means what you say, company, you are seeing more the companies they are at concalls, etc. Do you see technicals and fundamentals, economy of the country or world, etc.?
Yeah, see, it's sort of combined. See, okay, again, so I don't think of it on those terms. So what I think is relevant, I take, and what I think is not relevant or what I'm not able to process, I just reject. So what variable? So there is a decision I have to make, right? And do I have so decision is yes, no, or don't know. So if there are not enough information points for me to reach a yes, then it's a no or a don't know, right? So till I reach that point, I'll keep searching for different kind of stuff. So I do look at see, just as an example, so I was very excited about tires recently, and in that I did look at, for example, the fact that China ka dumping, I mean, anti-dumping has been set up by Europe. India is slowly becoming, so I don't know if this is answers, but let me explain a few points in tires, right? So if you take any major market in the world, the top tire players are the international players, right? Which is Bridgestone, Yokohama, Michelin, Pirelli, etc. Most major markets. So they have captured the local market by buying out competition, etc. China may, the local players are strong, but still these guys have a good share, is what I understand. India is the only market where they have been marginalized by domestic tire manufacturers. So that was very interesting to me, right? So that is a global view that I've taken. Now, you can call this a macro view, you can call this a micro view. So again, I don't think of it in those terms, right? Where because of this what is happening in Russia, Ukraine, and China COVID, there is a desire by the Western world to de-risk from smaller number of countries. So there is increasing number of exports. There is increasing number of exports that is happening from India to Europe in tires, and maybe other things also, but for specifically tires. So in tires, if you see, the export numbers of Indian companies are really good this year, right? So that is also probably a macro angle. And coming to technical, I do look at technical to some extent. I'm not able to articulate it well today, but I do look at technical a little bit to figure out whether to average up or not, and etc., or whether to enter or not, etc. I do look at it to some extent. So, for example, I find it interesting that the Nifty IT index is 30% below, right? That is interesting. So, the time I entered the Nifty Realty Index, it was at a very low number, for example. And so I do look at a little bit, but it is a supporting factor in the core fundamental analysis. Even macro is a supporting factor, I would say. And I don't, I mean, see, I don't think of it as micro, macro, etc. It's an information point which is an input into the process. If I start thinking of micro, macro, do I understand this? Do I really think it is relevant to the situation? That's how I think about it. I don't think of it as macro, micro.
Right. You basically company based.
Company.
Based.
So again,
sector to sector.
So okay, so I should explain that a little more. But what people call macro, I don't see it as macro. I see it as an input into my analysis. It could be macro as defined conventionally, but that doesn't matter to me. So I don't say कि हाँ आज मैं इसके बारे में macro थोड़ा पढ़ता हूँ. I don't approach it that way. I read a lot, and that comes as an input. So I'll start Googling tire companies, what is happening in tire companies. I'll read random con calls. I'll read what's happening in, I might read some advertisements in Europe. So that comes under technically macro, because it will talk about tire companies selling more, or anti-dumping of tire companies by China, against Chinese tire companies. I'll look at what is happening geopolitically. So all that comes into my thesis on the tire companies. So this geopolitics, etc., is not technically micro, but it is an important factor in the investing as well.
Right. Thank you, Rohit. I will be interested in your Kindle version of the Intelligent Fanatics.
Sure, Mr. Bajaj. That's so nice of you to ask. Yeah, sure. Yeah.
So Rohit, I'll just take one last question, which was there on the chat box.
Sure.
It's from Muskan. What is your exit strategy, given that you bet on cyclicals? So how do you exit the stock? What are the exit triggers, whether it's just valuation or any business metric? I think that's a very good question, actually.
Yeah, so that's a very difficult question also. So it's, I mean, it's like Abhimanyu, Muskan. I know it's easy to get in, but I don't have a good answer for getting out. But having said that, see, I have a broad idea of the value of the company, right? And once it reaches around that level, I try and take some money off the table. So generally, how I look at is, for a unit of risk, am I getting 3-4 units of reward, right? So simply put, I mean, this is very basic, but 3-4x agar ho gaya, then I might seriously think of taking some money off the table. Because I generally buy something at maybe 25-30% of the intrinsic value is roughly how I would put it. So then I'll take some money off the table, and then I have a technical indicator which Ashish Kila had shared in one presentation, I believe, which I try and use to figure out an exit. It's something which I've never used yet. I want to apply it right now, but it's something that I'll keep in mind and I try and use it. So it's an attempt on my part to figure out if I can capture the fundamental as well as the excitement value, or the so there is panic and mania. So I buy in panic and I want to sell in mania. So is there a way to figure out if I can hold on to some part in mania also? So I'll take some money off the table so that my capital is protected and maybe some profit is protected, and then try and play the remaining money. So it's like the house money, right? In poker or somewhere, you have so you make money and then you can bet aggressively because you have the house money. So that's how I will sort of approach it.
Thanks, Rohit. So I see a lot of messages for your Kindle version of the book. So you can share that.
Actually, I should have. I'll ask Ian and Sean. I think they should be okay, but I'll get back to you on that, Ankit.
I think Akshay mentioned this on the chat, that I heard Rohit on Planet Macrocap, the interview during, I guess, 2019.
Yeah. That had happened when I was in US. Yes. I'd forgotten about it, to be honest. Yeah.
Said that there are only 2 video or audio interviews of Rohit on YouTube. Very profound every time. So I thought that.
Okay. That's very nice of him to say, actually. Thank you so much.
Yeah, I'll just ask last 2 questions here.
Sure.
So which I generally ask to all my guests.
Sure.
So the first one would be, you are not only a writer, but also a voracious reader. I know you personally. So
Sure.
top 2-3 books that have helped you become a better investor or a better thinker. And please avoid mentioning the Buffett letters and Munger's interviews and all, because we all know those are holy grails and kind of indispensable for investors, right? Apart from those two.
Yeah, so for me, Taleb books are phenomenal. I have not read or heard anything apart from the books that is written, the three of them, A Fool by Randomness, Black Swan, Anti-Fragility. I mean, I love them. So they have shaped me a lot. Capital Returns is another book that comes to mind. That has also been influential in my framework of thinking, etc. Then I am enjoying, I don't know how to incorporate into my thinking it, but I'm enjoying a lot of books from the Santa Fe Institute and Complexity. I think it's something which we briefly discussed, but it's still a work in progress. So books from the Santa Fe Institute on complexity is a book called Scale by Jeffrey West, then Complexity by Mitchell Waldrop. So all those are books which I am working on, and I really want to understand that more. It's very difficult for me. Then I think somebody asked for philosophy books. So for me, so I found the book Infinite Vision by Arvind Aikar, the book of Arvind Aikar, to be a business as well as a philosophy book. It's beautiful. The Untethered Soul is the best book for me in this year. That's also a book on philosophy and self-discovery, etc. So that's also something that I would strongly recommend. There's one more book which is slipping my mind, but I'll probably share it on philosophy again, that's something which I'm going through right now, and I'm finding it very interesting.
Sure, Rohit. So we are coming to the end of the session finally. So 2 hours went by. I didn't feel like कि 2 घंटे बैठ के इतना time हुआ है. So I know, and I think all of our Mission Smile members also enjoyed it thoroughly. So thank you so much, Rohit, for sharing your time, experience, and wisdom with us. And I would just like for your closing comment or any piece of advice for our Mission Smile community. So just to spell it out for you, Mission Smile stands for making new stock market investors learn it through engaging research. That's our aim at SmartSync and Mission Smile. Yeah.
Perfect. So nothing like that. So I think you've, I mean, I spoke a lot, so no more advice per se. But the only thing I would, it took me a lot of time to figure out. But please, so listen to yourself, stay true to yourself. The style of investing which works for me might not work for you, which works for Buffett Munger might not work for you. There is a style out there which is a synthesis of a lot of things that you guys will read because of your experiences. So my suggestion to you would be to introspect more and figure out what allows you to sleep at night calmly. That's the only suggestion I have.
Yeah, I completely agree with you, Rohit, and I also have a similar sort of philosophy about investing in life, is that knowing yourself, what you want to do in life and what you want to do in investing is also very important. Sometimes we get too much influenced by the company we keep, even though we have a very good company at times, but we may get influenced and we don't be ourselves. That is, I think, would be would not be something which we should be doing, right? To be a better version of yourself or being a more authentic version of yourself is probably the right way of doing anything, be it investing or be it anything in life, right?
Agreed. Totally agreed with you, Ankit. Thank you so much for this opportunity again.
Thank you so much, Rohit, and thank you so much, everyone, for staying patient and listening, and also asking some really good questions. I hope you enjoyed the whole session. Dr. Suvid has already tweeted about it. Thank you so much. I would request others to also spread the word so that more and more people can learn from this. We'll share the recording as soon as possible. Thank you so much, Rohit. And thank you so much, everyone.
Thank you, everybody, for listening in. I appreciate it. Thank you.
As I said, I am sure you must have enjoyed this video of Rohit as I did it when I hosted him. I would still urge you to go back and watch this video again after a few days, because there are so many finer nuances which Rohit has touched upon in this video, I would say that it is difficult to digest everything at one go. Rather than that, I would urge you to keep notes of whatever the important points which you liked in the video and revisit them maybe a couple of months from now. And that will help you understand and develop or improve as an investor. I hope you enjoy watching some high quality research content on our YouTube channel, Smart Sync Services. So keep liking, keep sharing, and keep subscribing to our YouTube channel so that we can grow. Thank you.